Hello. Today we're going to speak about the art of accountancy, um, and how it relates to recreation and leisure services, and kind of begin to introduce the differences between the three sectors: the private, public, and not-for-profit sectors. So, what is accounting? Well, it's the recording, the acquisition of materials, keeping track of inventories, measuring output, analyzing the cost of goods sold, and also managing the profitability of the company or the agency, the organization. Accounting is quite an old art, although what we think of kind of more modern accounting it still was probably, I believe, developed in the, in Middle Ages. 1500s, but we have evidence that even writing was developed by accounting. The very first marks on clay tablets were jotting notches for the counting, probably of trades that were for goods and services that they were, well, they probably didn't trade services, for goods that they were trading. So accountancy is the recording the acquisition of materials, as I said, keeping track of inventories, output, the cost of goods sold, and the profitability. An accountant is obviously the person who oversees or participating in the maintenance of financial reporting system. And most of the time you have an accountant. You as a professional most likely will not have to do accounting yourself. You will work with an accountant. And whether that is, if you're obviously a private firm, you might hire an accountant. You may do your own accounting though. But with not-for-profits and public, obviously there's, someone who's hired usually for doing accounting. And accounting is the art of recording all of this, of summarizing it in a significant manner in terms of money, transactions, and the events, kind of describing their character and interpreting the results. So why do you need to learn this? Why do you need to understand accounting? Well, in every job you will have, you're going to need to understand a bit of accounting, and you will work with an accountant or some other financial manager. You're going to need to understand this in every mid to upper level job. Most of the time, if you're more of an entry-level job, specifically maybe like running a program, you're not going to need to know accounting. But, the more managing role or director role that you have, the more likely you'll be involved with accounting. You need to know the terminology so that you can communicate with the public. This is especially important, obviously, in the public sector, but also in the not-for-profit sector. You need to be able to communicate certain things, and it's in the public sector, it's your obligation to do so because of transparency. And it's really important to be able to understand the financial status of your organization, as well as to be able to spot financial wrongdoings. I mentioned this in the previous lecture, where I discussed the fact that there can be, or accounting problems happen all the time, where people are undergoing fraud in an organization, stealing money. And also you need to understand how to read financial statements and general accounting, also just to be able to know how to manage something, where attention needs, where resources need, where do you need to try to cut costs, etc. Accounting has a language of its own. Leisure service professionals need to learn this language. Think of it just like math. There's lots of languages of things that we need to learn. So you need to understand the terminology. And unfortunately, there's no real way. I mean, you can kind of understand it, but you're going to need to memorize some of these terms. So in order to understand and speak some of the language, we need to know the terminology. So we're going to learn about what accounting is, the language of accounting, and how accounting is done. And again, why do you need to learn this? Partly you will benefit personally too from understanding a bit of accounting. If you know some of the language, then you can manage your personal finances better, or spot errors, or speak to the bank or an accountant better. You'll also be able to follow the news and other media sources. You will then, you can just, for example, you're going to be, after this course, you are going to be able to watch Dragon's Den in a whole new way and understand better, what they're actually talking about. So, the first thing are, what are transactions? Well, a transaction is an exchange. That's just even what the word means in English. It's an exchange, in this case, of goods, services, or money. And the records of those exchanges or those transactions are recorded in journals and ledgers. They're usually recorded in chronological order, and they're assigned different accounting numbers. And this is then added up to create a balance. You probably, when I was a kid and you opened up your first bank, I remember going to the TD Bank, and it was called My First Account. And way back in the day, you didn't go on the computer to look at your transactions. It was all printed in a little book. And, and it showed you, each transaction and then what your account balance is. So, and obviously, it's very similar then to what you see in your bank account, online now. It's a list of transactions in chronological order. I'm going to explain journals and ledgers a little bit later on in this lecture. So, there are various term differences between the private, not-for-profit, and public sectors, and I'm going to explain that a little in another lecture video. I'll be going over this handout. So on our course shell, you'll find this handout. I actually developed this when I was, as I've mentioned, my education background is not really in organization and administration. So I had to do a lot of reading in order to be able to develop this course. And when I was, myself reading this chapter, I developed this table just to understand all the different terms. So we have to know that for one thing, usually you have equity, which is like the value of a company or the entity, as they call it. And obviously there are expenditures or, your negatives coming out. Then you have positives coming in. And all of this then is, organized in a certain way. And there's different accounting practices that are used. As I said, I'm going to go through this particular handout in another video lecture. So there are different types of accounting. So you might have seen on that previous slide, there is what's called full accrual accounting, and there's modified accrual accounting, and there's also cash accounting. And so in order to understand the difference between the types of accounting, we first have to understand what depreciation is and what fixed assets are. So depreciate, the word means, to reduce, to go down. So it's a concept that some fixed assets, such as buildings and equipment, get used up and lose their value. They decrease or lose in value of fixed assets because of age, wear, or the market condition. So a fixed asset, by definition, is anything that depreciates, that gets old. So buildings depreciate, vehicles depreciate. Equipment depreciates. Think of, when you buy a car, you might have paid $20,000 for that car. The second you drive off the lot, that car has depreciates in value. It actually happens. It's only a meter long and to a couple of seconds, and it's already gone down probably by $5,000. So, but not everything depreciates. Land, for example, never gets used up, so it doesn't depreciate. But buildings, vehicles, these fixed assets have life expectancy. For businesses, the private sector, depreciation is a tax-deductible business expense. So if you're in the commercial private sector, you can, claim these depreciated goods on your tax. For not-for-profits, they don't pay taxes, so depreciation really isn't an issue. But in the public and government sectors, they don't actually look at depreciation. They use what's called modified accrual accounting, and it doesn't depreciate during the useful life, but extinguishes when the assets are taken off the line. So depreciation then is a reduction in the value of these things due to aging. So the life of this fixed asset then has to be estimated. And then you get what's called a salvage value that's estimated. And this is deducted from the original purchase price. And this is then divided by the number of years and subtracted from the original cost each year. You don't need to quite understand all that, but you should just understand that basically, there's a formula to figure out what is the life of, a building, a piece of equipment, and then how much is it going to go down in salvage value, and then by, how many years. So one of the types of accrual, there's accrual accounting and cash accounting. But we're speaking of the difference here between full accrual and modified accrual. Full accrual accounting is used in businesses because they claim the depreciation of fixed assets. Now I'm going to admit here, I have not-for-profit accounting here. I haven't quite figured out exactly which type of accounting in Canada not-for-profits use. In the textbook, which is American, it talks about not-for-profit using full accrual accounting. But I'm not sure if that's true in Canada, and it could be different. And as I've mentioned then, this full accrual accounting takes into consideration the depreciation of fixed assets. And there's counting principles, and they're prescribed by the governing agency. So, in Canada, it's, Canada Revenue Agency. And you need to, in full accrual accounting, the main aim is that it records the equity on a balance sheet. Equity then is the worth or value of that organization. In contrast, modified accrual accounting, it's called modified because it doesn't depreciate assets. And here you can see I've got not-for-profit and government accounting. I'm not sure about not-for-profit, but definitely governments in Canada use modified accrual accounting. Please note that on the exam, I'm not going to ask you a question about not-for-profit accounting, or if I did, I would accept it's just accrual accounting. I'm not sure if it's modified or full. And again, this is prescribed by agencies in Canada, and in this case, they record what's called fund balances on the balance sheet rather than equity. And a fund balance is it's called fund accounting because you don't have accounts, you have funds, because public or government sector is not allowed to make profit. So they call it fund balances. And again, you'll probably understand this a little better when you watch the other lecture on the term differences. Now, cash-based accounting is really easy. It's just, if you have ever, if you've been a Girl Guide and, sold cookies or worked at a, canteen stand or anything like that, Tim Hortons, you might have done cash accounting. It's very similar to what individuals do in their personal checkbooks, where only what is received or paid is recorded. Records of transactions where money has actually been received or dispersed. So it's very basic accounting, and often used by it can be used by any organization or for different programs. So you sometimes have to do cash accounting, for a specific program, or it can be used, let's say your business is very small and for example, you only have to be actually be registered as a real business if your profit, if you're making more like $30,000 or more, it might even be higher than that. So if you just have like this tiny, like a side little business, you're probably then using cash-based accounting. There is a video that explains the differences in the accounting methods, cash versus accrual accounting. This is American, so please note that I'm not sure if they do talk about not-for-profits. I'm not exactly sure if that's correct, but it does explain to you what cash versus accrual is and gets in a little bit into the difference between full and modified in terms of depreciation. So back to what journals and ledgers are. So remember, we've got our transactions, which is the records of basically the ins and outs. And these are recorded in journals and ledgers. What's the difference between them? Well, a journal is a book in which transactions are recorded in chronological order. There's a running balance is kept of the total balance of the fund. So think of this as your a bank account sort of a thing. So a journal would be, I'm looking at my RBC checking account, and each time something goes in or out, a journal is kept that records then how much money is left in my bank account. So it's very similar to that. Where a ledger is recording multiple bank accounts or multiple accounts or funds, okay? So it is a book where, and they're calling it a book, obviously it's electronic now, but where transactions are recorded by account in chronological order. And a running balance is kept of each of the different funds or accounts. And there's two types of ledgers. There's general ledger and nominal ledger. And these are, obviously books or electronic files where specific accounts are recorded. And I'll discuss that later. So if you think of like a ledger, so for myself, for example, I have multiple bank accounts. I have my RBC checking account. I have my a US bank account. I have ING savings account, TFSA it's actually called. So a ledger then would be, I'm recording the transactions. Usually you take the information from your journal and then you add it to the ledger, and you're recording, I then would be recording every single in and out, but which bank account it came out of. And then I would be recording what the balances of each of my 3 different accounts. So a journal is just for like one bank account, where a ledger is for multiple accounts or funds. So here's a sample journal. This is a simple one, often used in business. They don't need to be as detailed and often only record income. So here, this is a lawyer. They have they've got July 5th. They had a client, Peter Piper, and they were doing a corporate retainer for him. They have got the purpose there, and they put the amount that Peter Piper paid, and then the method they got it, like a check. And obviously, like in real, you probably record the check number as well, and that sort of thing. Although checks are going out now. So it's you can see it's quite simple, and it's just explaining each of the transactions. Here's a cash journal. So it's the same thing, but it's about cash. So the account asks for specifics to be recorded, but generally includes the date of transaction, the fund posted to, and the activity that the fund, and whether it's a debit or credit. So here they've got the date, they've got the particulars like the name, they gave a receipt, and they've got there are different kind of accounts or whatever it is for their different categories. So for example, on October 4th, there was member dues of 175, and they've got that categorized as member dues. And they've got that then, so they've got how many member dues, for example, in this journal. Obviously the total would be only 175. And a journal is then used, you double check everything to make sure all the numbers line up. Another simple one, you're just, what's the cash in and what's the cash out? So here, obviously, I can't remember what this example was exactly, but an antique bath was sold for $10,700. They had to purchase heating fuel, and that was $321. So it goes on. Oh, my guess is this is a plumbing company. Now here are ledgers. So here's the ledger again for that same lawyer company, Leslie Lawyer. But notice now she's created different accounts. So she has an account for Peter Piper. She has an account for Kim Kirby, who is another client. And then she's got the dates, the particulars, the ins and outs, and then the balance of each of those different accounts or funds. Now, obviously, depending on the company or also type of organization, you're going to have different types of accounts. This is a lawyer, so their accounts are about clients. Another one might be specific bank accounts, or it might be ones for savings and ones, checking. There's all different ways of recording this. This is a general ledger. So, and here you can see that a general ledger is for a specific bank account. So, and it is usually, obviously, the dates, and it goes ins and outs, and then the balance. Pardon me, I forgot to mention there that a general ledger is a collection of the account groups that supports the value of the items shown in the major financial statements. It's built by posting transactions recorded in the sales daybook, purchases daybook, case daybook, and general journal daybook. So this is basically saying that you usually have all these, back in the day, they used to have not electronics, so they actually had separate books for each of these. And we just still use that language, that there's like a book for sales, a book for purchases, etc. And all of this then is recorded in the general ledger for the day. So when we're posting transactions, a general accepted accounting procedure is to do double entry bookkeeping. And that's the process of writing down transactions in chronological order in a journal and then posting the transactions to accounts in the ledger. So The general ledger then is used for double entry bookkeeping. It's the main accounting record of businesses that use double entry bookkeeping. And sometimes this is another word for it is sometimes called the nominal ledger. Here's a YouTube video that is good for you to watch explaining what double entry bookkeeping is if you're interested in learning a little bit more. Normally would show this in class. The link is also posted on under this unit on the course shell. There's also T accounts. So this is a visual aid used by accountants to illustrate the effect of a journal entry on the general ledger accounts. So debit amounts, debit means, takeaways, negatives, expenses. Debit amounts are entered on the left side of the T. You can see it makes a T. And credit amounts are entered on the right side. And usually, this is done by then all these different accounts. You might have your expenses versus revenues, or you might be looking at assets versus liabilities, or etc. So credits are obviously positive. Credits represent an increase in resource. And I apologize, I should actually flip the way I have this on the slide. Credits are always on the right side of the bookkeeping. I should really have put debits first on this slide and then credit. That would make more sense. But entries on the right side of double entry bookkeeping accounts that represent reduction of an asset or an expense, or the addition of a liability or revenue. So positives go on the right-hand side, where debits are on the left-hand side of the T. These represent a depletion of resources held by the entity being a name, fancy name for an organization. At the bottom of the, entries on the left, they're on the left side, and they represent the addition of an asset or expense or the reduction. And at the bottom of the ledger page is a net total. So the net total of debits and the net total of credits. So you add up all your positives that came in to get a total, and you also add up all the debits, the expenses to get a total. Then you can get a dollar amount of the debit and credit transactions. Another term you need to understand is income. Income is money coming into the entity from any source that increases the entity's equity. So income can be anything, or it's also obviously revenues are part of income, but it could be income is viewed then of any type of money. So it could also be a grant, for example. Some other terms and concepts that you need to know that we'll be discussing more and more throughout this term. A balance sheet. A balance sheet is a report that provides a picture of the financial condition of an organization at a given point in time. It includes the assets, the liabilities, and the equity for a fund. So a balance sheet is, specific to a fund or organization, and then is showing what are the positives, what are the negatives, and what is the worth of the company. Paper-based accounting is another term that's often used. Obviously, the paper books don't really exist. As described, all calculations in paper-based are done manually, and reports are constructed from account balances. Where today, more and more, we do computer-based accounting, where transactions are in a chronological order, reports are constructed by the computer when commands are provided. And I really encourage you, if you haven't done so already, start to learn, play with personal programs for, personal accounting. Often there's free. There's often with your banks, they recommend certain ones that they link to, or you can get fancy like with Quicken or that sort of thing. But they're really easy to use, and generally have you can sort things, and it makes accounting very easy. And finally, you should understand that there's a code of ethics. All professions, many professions have a code of ethics, or values, at least statement. And actually, by definition, a profession must have, in order to be viewed as a profession, it needs to have a code of ethics. And these are usually generally define honesty and the best policy. So there is a code of ethics for accounting. As recording transactions honestly is very important. And an ethical dilemma in which codes of ethics, leisure service financial managers should focus on is, what do you, there can be ethical dilemmas about doing the right thing when you've got competing codes are different. And I'll give an example. An ethical dilemma might be, for example, back in we don't actually have this anymore, but it used to be that, for example, cigarette companies and alcohol companies funded a lot of recreation and social events, community events. For example, the famous Montreal Music Festival used to be called the Des Maurier Music Festival. And then in Canada, it was actually decided they're not, cigarette companies were not allowed actually to sponsor these. It became a law. But we do still have this with alcohol and other things a little bit. So for example, maybe you have a program for an after-school program for children, but the only funding you try and you get funding from like an alcohol company. Is that ethical then to be taking that income? So, and obviously to me that is a competing code, because it goes against the code of doing what's best for a child's health. So that's the art of accountancy. I know this is very hard and long to get through. Be much easier to be together in class, to have a little chit chat about it. I encourage you to read the chapter, and also as I said, also make sure that you watch the video on the accounting term differences. I'll go through that. And again, remember that this unit, though, you really need to understand what these terms are, because they really form the basis for the rest of the term. So make sure that you have an understanding of this terminology, as it'll carry forth for the rest of the units.